Welcome to the Lauder Institute at the University of Pennsylvania. I'm Jules van Binsbergen, director of the Institute and a finance professor at the Wharton School.
And I'm Jonathan Berk, a finance professor at the Graduate School of Business at Stanford University. This is the All Else Equal podcast.
Okay, welcome back, everybody. Today, we are going to talk about investment advice, financial advice that you can get pretty much everywhere, Jonathan. I don't think it's very hard to get people to tell you what you should be investing your money in. Lots of people claim or believe that they have the skill to tell you what you should be doing. I think that even when you take an Uber ride or a taxi ride, it's not very difficult to hear from the person driving the taxi where you should put your investments. And so what we want to do in this episode is, how should you judge whose investment advice to take?
Yeah, and I mean, Jules, not to be facetious, obviously the Uber driver is not somebody you should listen to, but often people arrive who seem to have a lot of credibility and giving you investment advice. And I would argue that most of those people are giving you bad advice. So even credible people, I would say you have to be able to decide, is the advice worth taking?
So suppose that a person comes to you with a stock pick and says, I believe that Tesla is the place where you should put your money in Tesla. What do you say to that person?
I think the most important thing is, how credible is it? So let's start with various people coming to you with investment advice. So let's start on the internet. There's a chat room or there's a message room or something where somebody is claiming to have given great investment advice, and he gives this investment advice that you should buy Tesla. Should you listen to that advice?
Well, I think that the first answer that we would give is probably not. And the reason is, let's think about what the incentives are for both parties for what is going on in this interaction. So suppose that there is a person who truly knew that Tesla was a good buy because they had done all the research, they had done the corporate valuation, they did the present value of all the cash flows and came to the conclusion, hey, Tesla is really undervalued. Then the question is, what are the reasons for why such a person would advertise that on that messaging board? Now, there are a couple of possible explanations. The first one is this person actually themselves put a lot of money in Tesla because they believe what they're saying, and they're trying to convince you that you should also be buying it, or convince not just you, but a whole bunch of other people on that messaging board to buy Tesla. And by doing so, I think that person is hoping that Tesla's price will be driven up.
Let's differentiate. Let's just say that's the only motivation. They haven't actually done any research, and they are trying to get you to buy it because you will drive the price up, and in doing so, they can get out. If you drive the price of a stock up and nobody else buys, then when you sell, the stock's going to go back down again. So you can't make money. But if other people could drive the stock price up and you can get out while they're driving it up, you can make money even if there isn't any underlying news. This is called a pump and dump scheme. So the question is, that's one motivation for somebody on a message board to give people stock picks, right? Now, let's say that was not the motivation. Let's say this person on the message board really had done their research. Okay, the next question one has to ask is, how competent are they at doing the research? A person who's really good at picking stocks, is the best way for them to make money out of their skill at picking stocks a message board? Probably not.
No, so let's then differentiate there, which is there are people that do these type of valuations and they work for investment banks. And in these investment banks, they write newsletters. And in those newsletters, they have for all stocks, they have a buy advice, a hold advice, or a sell advice. So maybe if they truly do have the skill, would that be the right place for them to actually be working and thereby giving people advice through those newsletters?
But really, that's not the big money, right? The big money is, if you really can find underpriced stocks, the big money is invest yourself.
Yes.
Now you may argue, well, okay, I don't have the capital to invest. Well, there are lots of people who might be willing to give you capital if they really are convinced that you can correctly pick stocks.
So then those people should become portfolio managers in mutual funds and therefore collect the capital from a lot of different people and invest on their behalf. And so, of course, we know that there are many active mutual funds traded in the United States where those people can pick stocks to their heart's desire and show the world how good they are at picking those stocks.
You know, part of our results in this area, one of the strongest results, is that those people are indifferent between taking other people's money to manage and managing their own money. In other words, the constraint that they don't have enough of their own money to make money off their stock picks is actually not a constraint. In other words, if they take other people's money, once it's clear to these other people that they really have the ability to pick stocks, the competition to invest with them gives all the reins to the person with the skill, the person who's picking stocks, making the person indifferent between managing his own money or managing other people's money. So he can get all the benefits of his ability to pick stocks with no capital constraint. So if that's the case, why would you choose any other means of making money? If you can get all the benefit of your stock picks yourself, there's no other place to make even more money. And so that is where you should put your skill. You should manage money.
And there's another test, actually, Jonathan, that we could easily do, right? And I think we already know what the empirical result is going to show there, which is, does it ever happen that the person who gives these advices on these boards, on these messaging boards, is actually hired as a mutual fund manager by a mutual fund company because they were writing these advices on those messaging boards? And I think that's a very rare way of becoming a mutual fund manager. So that actually says a lot, wouldn't you say?
A huge amount. And so I think what we're saying here pretty categorically is exceptionally unlikely that anybody on a message board has any ability to pick stocks. There's a much better place for that person to monetize their skill than a message board. So if they're on a message board, it means they are not very good at picking stocks.
So, Jonathan, what about financial advisors? If we think about financial advisors giving you specific stock picks, what are we supposed to do with that? Because I think the argument we just made actually still holds, which is if those people really were that good at picking stocks, they wouldn't be advising individuals what stocks to invest in. They would actually be managing money themselves and running large funds. And so I do think that therefore we should really make a difference between the types of advices that financial advisors give. And I think that stock picks is actually not the type of advice that you should get from a financial advisor. But there are other things I think that financial advisor can tell you that might be useful things, such as that you should diversify your portfolio or how much money you should save for retirement. I think those are sort of standard things that many people are not that aware of and could use some help with. But also, I think that those choices are just optimal individual choices that people can make without having to worry about the effect of the choices that other people make in the market.
I largely agree with everything you said, Jules. I think that if you have a financial advisor and the primary thing he's doing is calling you with stock picks, you should be incredibly suspicious. Because as we said, if you're really good at picking stocks, you need to have enough capital to make the capital work for your stock picks. And the problem with a financial advisor, for somebody who is not super wealthy, is the amount of money that he has at his disposal isn't really big enough to leverage his ability to pick stocks. So another way of saying that is, if somebody's claiming to pick stocks, the question is how much capital can he bring to bear? And if the number's small, it's an indication that he's probably not very good, because if he was better at it, he'd be working for a company that could put enough capital to bear, so he gets the full benefit of his stock base. On the other hand, I think there are many, many good financial advisors who stay away from that job. Instead, they work on, correctly diversifying, managing your taxes, and doing all these things that can be value added, but are not stock picking advice.
Agreed. So now let's move to the next category. We've been talking about stock picks, which are public investments. What about private investments? So private investments are a bit harder, I think, because they're more opaque. There's much less information available about them. They're not liquidly traded, so you cannot get a price signal on them all the time. So if somebody tells you, here's a private investment that you should really put a lot of your money in, what should you do as an investor there? Should you take that advice? And under what circumstances, under what sort of characteristics of the person giving you the advice, should you be going along with that?
Yeah, so I think there, again, the same answer is, how much capital can you bring to bear? And if you're small, you have to ask the question, why would the private investment guy come and talk to you when there are lots of very large players who play in the private investment space? And again, I think the answer is very simple. If the private investment guy is talking to you, it means he's not very good because he's been turned down by the big money. Now, the next question is, what about the big money, right? When we look at these pension funds and we see them all running to private investment, like private equity and hedge funds, are they making the right decision?
Well, let's just first agree. We had an episode on private equity investments, and whether or not these funds are making the right decision isn't actually so easy to determine, Jonathan, because if you really want to hold these investments accountable to a proper benchmark, there's lots of debate what that proper benchmark needs to look like. And depending on the benchmark that you pick, maybe some of those large parties did make good investment decisions, or as Ludo Filippo, our guest, argued, they didn't make such good investment decisions because those private investments actually didn't do so well compared to public alternatives.
Okay, but I think there is an underappreciated skill here, which is the skill of the investor, right? In private investment, when there's a large opacity, difficult to observe the underlying investments. It's also difficult to observe the managers. Different investors might have different skill in picking managers. And I think there's not enough emphasis on that. So, for example, the famed investment strategy of David Swensen at the Yale Endowment, certainly he had amazing returns. But I don't think the returns resulted just because he put his money in private equity. I think the returns resulted because he has skill in separating good private equity investors from not so good private equity investors. And I think that in that space, people need to understand that in order to get the higher returns, you might have to have a skill in selecting managers. And if you don't have that skill, it's probably not the space you want to play in.
Although, Jonathan, I would say that that argument holds just as well for mutual fund managers, right?
Well, there's a lot less opacity, Jules. Remember, the mutual fund returns are easily observable, easily benchmarked.
But it's still the case that if you know better than all the other investors, particularly for early managers, who the talented managers are, I think there's money to be made there. You're just saying that that effect is even bigger in private markets than it is in mutual fund markets, because mutual fund markets tend to be more competitive and less opaque. In private markets, it's much harder to dig for the information. And if you are good at figuring out who the good and the bad ones are, the returns for investing with the good ones is higher.
And more importantly, you can't look at the returns of those skilled people and believe, oh, it's easy. I'll just invest in private equity, I'll get those returns. I think today there's a lot of money going into private investment that might be making that mistake, not realizing the amount of skill required in separating the high quality from the low quality managers, given the opacity.
Or, Jonathan, and I think that this is one of the big insights of most of the research that you and I have done together, if you are an investor and you don't have a competitive edge in either selecting stocks or managers or investments or anything else, should you really be going for that activity, or should you just acknowledge the fact that you need to just hold widely diversified portfolios, arguably in an indexed space, because you have no competitive advantage? If you don't have competitive advantages, don't expect to get any extra rents from those competitive advantages, because there's nothing to go on.
Yeah, so I would say, Jules, to answer the question at the beginning of this podcast, should you listen to investment advice? I think the answer is, for most of us, the answer is no. Diversify. But let's talk about another opportunity, and this probably a lot of our listeners have had, where they have the opportunity to be an angel investor. Somebody they know very well is starting a company at the very beginning, and they're asked to put money in an early stage. Does that make sense?
Well, so again, I think, and that's becoming the theme here, it is do you know something that other people don't know? And do you have a competitive advantage to be investing in that particular thing? And I think a second category of arguments could be that, there are non-financial reasons why you may want to be the person who invests. So let's first start with, are you the right person from an informational point of view? So let's use the example of us as professors, right? So as professors, we are often approached by our students, and our students say, I have a small company. I want to start this company. Do you as a professor want to invest with me as the entrepreneur? And so one argument that you could make is, we have observed these students intensely. We know how they think. We know how they make trade-offs and how good they are at that. We directly test in the exams whether they're good at their quantitative skills. We observe their reasoning. So why, if we see that a student is particularly good in, say, in the top 1 percentile of the class in a finance class, shouldn't that be an indication that we should be investing with them? Now, I do think that even in addition to the grade, we have more information about these people than lots of other people have. Although that still may not be enough for us to make that investment, it's still possible that there are other, say, private equity companies or venture capital firms that are angel investors that have a bigger competitive advantage to invest with their students than we do. But I'm curious to hear what you think, Jonathan.
Well, as you know, Jules, I did at one point in my life try this investment strategy, and it didn't work very well. Convincing me of the fact that simply knowing you have a bright student and knowing that they did well in your class is actually nowhere near enough information. And that the smart investors, it's a lot of information that they have, and that informational advantage really renders it unlikely to make money in that space without a lot of additional due diligence. And, that said, when you invest in the seed space or in the angel space, I think the crucial decision you need to make before you make the investment is ask yourself, am I helping somebody? Am I providing a subsidy? Or is this an arm's length investment? If, it's a friend of the family and it's somebody you know very well and you want to help them out and you want to give them some money and you don't expect to get a fair return, that's one thing. But if you are expecting to get a fair return, I think I would say, again, it is unlikely that you have a competitive advantage. That even in this space, there is a supply of capital for good ideas. And the fact that the person is coming to you is a pretty strong indication that they couldn't raise capital from the capital that supplies for good ideas, so that in fact it's a bad idea. I think it's going to be very hard to overcome that selection bias.
Yeah, actually, Jonathan, what you just said reminds me of something else that I think is an important point to make, which is the advantage of arm's length versus not arm's length. 2 weeks ago, with a group of Wharton Weekend Executive MBA students, we visited a number of private equity firms. And one of the things that the students were wondering about was, is it just the case that these private equity firms appoint their friends as CEOs? Or is it that there's an arm's length relationship when they appoint CEOs? And would it be bad if they appointed their friends, yes or no? And one realization that I got was the following, and that is, they actually turn over management teams quite quickly. So as soon as something doesn't work, you actually want to be able to pull the plug and get out or fire people. As soon as you start to appoint your friends, or as soon as you start to put your money with friends and family as a subsidy, that actually will withhold you from making the correct decision later. You will stick in it too long. You will not make the right decisions because you feel that loyalty and you start to, in your own mind, come up with excuses for why the performance really isn't so bad and why it really wasn't their fault and all of that. So I do think that in general, when you invest, there is an advantage to arm's length investing also so that you yourself can rationally make decisions and pull the plug when you need to.
Yeah. I agree with you, Jules. I think you have to be very, very careful when you participate in an angel or friends and family round. Obviously, if you've got a hotshot kid who's getting venture capital from established venture capital firms and there's a friends and family program, looks like they're probably doing you a favor. But absent that, you should probably not invest, even in an angel investment stage.
So that point, actually, let's elaborate on that a little bit, because what you're proposing is a hybrid model, which I actually really like, which is that suppose that you know that you don't have the competitive advantage to do all the monitoring and make the decision on whether this is a good investment. If the person gets financing both from the team that does monitor and from you, and therefore you co-invest with somebody who you know has done the monitoring, that might actually indeed be a much better way in investing in somebody than you thinking that you have the technology to do the monitoring yourself.
Yes, Jules. As you know, I have a paper coming on exactly that question. So yes, if a lead investor who's well known to have a reputation for picking managers invests, other people have this incentive to free ride on that information. But I will say that for the average listener here to this podcast, it's probably unlikely that they're being asked to invest as a co-investor when somebody with a reputation for picking has already invested. But I agree, in that case, it's probably a good idea to invest.
So then, Jonathan, let's go back to this private investment thing, right? When we talked about if you don't really have much of a competitive advantage in terms of monitoring or anything else, you should just index. And so you can just get a broadly diversified portfolio. But as you know, there is now this discussion going on that diversified portfolio, also for retirees, should actually include that whole private piece. So therefore, shouldn't the private part also be part of the indexed part? Or is it that if we exclude the private part, we're not really missing out on much? I do think that for an uninformed investor is still a choice that they have to make. Do you want to participate just in public market diversified portfolios, or do you want to have that private piece in there as well?
I agree, Jules. I mean, diversification says we should, especially since private markets are becoming a bigger part. It is okay for you to invest in a deal if there's somebody of very high reputation for being able to pick managers or who has previously invested. In that case, you've solved the selection problem. And the extent to which individual investors could get access to private markets that way is something there might be growth in the future. I mean, that's essentially the funded funds model. Having said that, it's still indirect. There's no way an individual, unless you're exceptionally wealthy, is going to get access to that market. It would have to be through your pension plan, who then invested in private markets. And I think that actually does happen. Let's talk about one last thing, which is one of our pet peeves in life, which is what happens when a manager comes to you and says to you, I have this great impact portfolio. I can both do good and get a higher return at the same time.
Yeah, I know. So what should we think of that? Well, you and I, Jonathan, have done quite some work on this. The first question that particularly say pension plans that are claiming that they can achieve that we should ask is, if they're so good at getting that higher return and picking stocks, what does that really have to do with the impact piece to begin with? Shouldn't they already have been very good at picking stocks then before? And I think that most pension plans actually have quite a horrible record in terms of picking stocks. So in the past, certainly they weren't able to pick the better investments. So somehow we would have to believe that active investing is actually really easy now. Now that we've discovered ESG, the only thing you have to do is pick the ESG stocks and the outperformance just falls in your lap, just like that. And that to me seems a little too easy. So I think that the statement, just invest with us because we do and good and you get a higher return seems like a very unlikely statement to be true.
Yeah, I would say this a different way, which is basically the same thing. And that is a manager who says to you, I can both do good and give you higher returns, is saying to you that he can pick stocks, and moreover, that he wasn't picking stocks previously correctly, because if he was picking stocks previously correctly, he'd already hold these good stocks. That's really the question you have to ask. Is this guy good at picking stocks? And if the answer is no, then it's impossible. He cannot both give you a higher return and do good at the same time. It must be a trade-off. So if you're doing good, it's at the expense of returns. And I think that that's a crucial constraint. That anytime somebody comes to you and says they can do both, you should be exceptionally suspicious. It's very unlikely.
Absolutely. Because let's add another very clear argument to this, right? Suppose I told you, Jonathan, I want you to pick stocks and you can pick whatever you want. I just want you to pick the best stocks. And I just want you to get outperformance without any constraints. And then the next day I changed my mind and I said, actually, I don't want you to just pick good stocks, period. I want you only to pick the good stocks that also do good. That by definition must mean that your choice set is restricted compared to yesterday, which by definition should mean that you will do worse than what you could have been achieving yesterday. So if in an unrestricted manner, when you could pick anything you wanted, you could already not do it and outperform, what is the probability that you're going to be able to do it when I restrict the choice set that you have on top of everything else? That makes it even less likely that you're going to be able to pick the right things. So constrained optimization problems always lead to lower optimums than unconstrained optimization problems. That seems like a pretty simple mathematical principle that also applies here.
So Jules, I think we can summarize this episode as saying, don't listen to investment advice.
Yes, or to be precise, don't listen to investment advice when it is about stock picks from people that have no track record or committed capital to them that gives you any indication that they know what stock picks are all about. If the financial advice is about hold diversified portfolios, manage your taxes better, or this is the amount of money that you should save for retirement, I think there's much more room there for good financial advice. Stock picks, stay away from them. Thanks for listening to the All Else Equal podcast. Please leave us a review at Apple Podcasts. We love to hear from our listeners. Also, be sure to catch our next episode by subscribing or following our show wherever you listen to your podcasts. For more information and episodes, visit allelseequalpodcast.com or follow us on LinkedIn. The All Else Equal podcast is a joint production of Stanford University's Graduate School of Business and the Lauder Institute at the University of Pennsylvania. It is produced by University FM.